For another Wednesday installment every week from 7 to 8 p.m. Eastern Standard Time. Here we are. So, Nvidia down 7-8% after hours. Stock market still kind of rough. We haven't really had a lot of great bullish sentiment. I think the Nasdaq's still down almost 30% from all-time highs earlier this year. In like January, we're down S&P, I think 18% or so. We've had a little bit of a bounce, but I think the general consensus is we're in the bear market. And so I thought this video might be a little bit timely. You guys can ask questions down below if you have any real estate questions, business questions, stock questions, whatever it is you're interested in. What do you invest in right now? It's tricky, if you invest in, well, typically during times of high inflation, you would jump to equities, right? Because most of these equities can pass on the inflationary pressure onto their customer. Normally, in high inflation times, you'd invest in asset classes like stocks or real estate because real estate can, again, also tend to pass on that inflation. As build costs rise, the price of properties tends to rise. However, in places like California, Ontario, where in Ontario, Canada, you can't pass on rent increases. Like your expenses can rise faster than your rents are capped to like 2-3%. So you can't necessarily pass on as much. And then at the same time, we have this weird, late 80s, early 90s era type of economy where we've got crazy inflation that might come down, that they're working on getting down. But to do that, they have to crank up interest rates and they basically have to crash the economy. The question is the economy strong enough to handle these rate increases that are happening? And as they happen, it will suppress the price of real estate, crash the price of pretty much stocks across the board. As you raise the long-term rates, as rates are expected to be 25, 30, 35, 40% higher, in the short term 60%, 70% higher than they were to borrow against for real estate, for stocks. I just want to throw this out there, a little tangent here. I've been watching a ton of great YouTubers out there and great Instagrammers out there that put together great clips about why real estate's amazing because of leverage and because you can borrow money to buy it. And they're like, I keep hearing people say, but you can't do that with stocks. You can't go, the bank's not going to lend you to go buy stocks. The bank's not going to go lend you to buy gold. The bank's not going to go lend you to buy crypto. Yes, it is. The cheapest possible money on earth is not tied to real estate. It's tied to blue chip equities. You can go buy gold, 70% loan to value mortgages from the bank. Interactive brokers, as an example, will lend you at prime minus, right now around 1.55, 1.6% interest, 70% loan to value against any of your blue chip holdings, whether it be gold stocks, S&P 500, name any of the big banks, whatever. You can for sure use leverage to buy equities. So there's just like this myth that real estate's the only way you can do that. And it mostly comes from real estate gurus who are looking to raise money or who are promoting the fact that they're into real estate. I'm a real estate investor through and through. Like, that's the way that I made my wealth. It is my key success factor. It is my competitive advantage. So I love real estate, don't get me wrong, but it's one asset class and it's a great one, by the way. I think that, right now I'm probably the least confident in real estate prices. The last time I was this unconfident was when I was watching things crash in early 2020 in my local market. We had a 20% pullback on the prices and there were no offers. It was dead. COVID was out and no one knew what COVID was about. The market had crashed 40%. The stock market was down, like I said. And it was just, carnage because there was so much uncertainty. Even lenders were like, are we all going to die? I heard some stories about banks not putting debt through and just sitting on their hands for a second because no one knew what was going on. The world just locked in, right? I have that same feeling now. And I feel like we aren't there yet. We're not to the bottom. We're getting closer. You're seeing days on market increase. We're seeing inventory levels increasing. Demand is dropping. Supply is increasing. Eventually, the new lower comparables will come out and that should drive prices down a tad. Am I so bullish to say that the price now will be lower in 5 years? No, I don't think so. I think the price of real estate will probably be higher 5 years from now. So if you have property and you're worried about it and you're underwater, hold, right? We only buy cash flowing real estate. We don't buy garbage that doesn't cash flow. So who cares? We'll just hold. But if you're a flipper right now, or you can't hold, it's not a cash flow property, you're flipping stuff that isn't cash flow positive and you're forced to hold, or you have high interest debt attached to it, there's risk, right? And so it's just something to be cognizant of in these times. And so I'm thinking to myself, like, what do you invest in? What do you invest in these times? And one of the things that I'm feeling really good about is lending. I know it sounds weird, right? We're in a high inflationary environment, but I feel like if you can take a position where you could be secured against, say, real estate, you could secure a first mortgage, 70% loan to value. If, say, the stock market pulls back 20%, 25%, you've lent on a quality asset, their equity is, if you're letting 70% loan to value, they have 30% equity in the game. Their equity starts to disappear. Yours is completely safe. I think a 25% pullback would be the most we would probably see. I think it's more likely we see a 10 or 15% pullback and then a flattening for a long period of time where we don't get the appreciation we had before. I think lending is great right now. There are still a ton of deals out there to fund. If you're in the right network, you can find opportunities to lend at between 8 and 15%, depending on how much risk you want to take, right? The more risk you take, the more reward you're going to get. Like, there are people who will take second mortgages at 20% right now. But again, you're in second position. It's a lot like having the equity on the, basically you're as safe as the down payment on a property, right? Because you're that last, like let's say the bank puts 75 or 80% down and you put your 20% down payment. Your down payment's the first thing that gets lost, right? It's the unsecured equity. That's the risky stuff. So you could do right now, you could take on deals where if you lent to, and I like to only lend to people who have really great track records, solid net worths, where like, if this deal goes completely south and the market tanks, can they still afford to pay me back? If the answer is yes, that's a big check that I'm looking for, right? I'm looking for a guy who's doing his first deal or his fourth deal and just starting out, doesn't have a lot of equity. That's not who I'm looking to lend to. I'm looking to lend to someone who's experienced, in many cases a flipper as well, but someone who's good at taking undervalued assets and turning them around. The reason for that is, even in a bear market, I think all the guys out there who are investing for 60 cents in the dollar, 70 cents in the dollar, they're turning these properties around. They're looking at 20% profit margin, right? They're buying for 70 cents in the dollar. They're putting 10 cents in the dollar in, maybe 5% in financing and whatnot. So they got a 15% profit margin. If the market tanks 15% and you're that kind of buyer, hopefully you're also buying cash flowing type properties as well. So you're buying duplexes, you're buying large multifamily, et cetera, so forth. These types of properties, your profit margin will be gone, sure, but you haven't lost any money. You've put in a bunch of effort and made almost no return, but you didn't lose anything. Where I'm afraid is I have these followers who reach out to me and say, hey, I'm buying a new build under contract and I'm putting $50,000 down. It's going to close in 2 years. I'm worried about those developers going belly up and you losing your deposit. I'm worried about the guy who's buying the condo in Toronto that's cash flow negative. I'm worried about the guy who's buying the single family in LA or the single family in Toronto or Vancouver that is cash flow negative at higher interest rates with a little bit of sensitivity analysis. They're quite cash flow negative. Or the person buying those Fanshawe college rentals, with $900,000 on a 5-bedroom house near Fanshawe College, which is not a nice area. And they're renting them for like $3,000 a month, losing $1,000 a month at least or more. Those investors I'm afraid for. So all real estate is not the same. I think that those investors who have built a business around real estate and are good at what they do in executing, either buying stuff under market or their execution pieces they can renovate for below cost, they have a key competitive advantage there. Or maybe they're an excellent operator and they're like running on Airbnb and making 30, 40, 50% returns through Airbnb. If things go south, it's okay because their return will go from 40% down to 20% or whatever. It'll cut their return, it'll suck, but it's still better than losing money. And I unfortunately have had the great fortune of selling a large stake of my real estate portfolio in January and divesting out of that and into the stock market and watching the NASDAQ fall 29% on my holdings. That was painful to watch, at least a third of my portfolio was exposed to the NASDAQ. And to watch that part of my portfolio just tank like 30%, it kind of got me realizing like over the long term, and I'm not going to sell, I don't need the money, I'm not going to panic sell. So like in 5 years, the NASDAQ, I'm sure will be better off than it is now. And like maybe we'll crash another 10% or we'll reach a 40% drawback on the NASDAQ, which would be pretty dire. But I can ride that. I'm not on margin. I'm okay. I'm comfortable. I can continue to hold through that time. But in real estate, if I had just taken all that capital and found a bunch of off-market properties and redeployed that capital into new, better deals, I'm confident right now that I'd be up $1 million or $2 million on that capital, as opposed to being down $1 million, right? So that was a revelation point for me. And it's like, well, one, I realized that I don't have a competitive advantage in trading the NASDAQ or the S&P 500. I can't out trade the best traders in the world that spend 12 hours a day, have PhDs in finance, whole teams behind them, Bloomberg terminals, insider information, and all the rest. And they still, 95% of the time, don't beat the benchmark index. The pros who do it 80 hours a week, how could I do it 2 hours a week on my phone in my house with no team? How could I expect to outperform them, right? Statistically speaking, I won't outperform them over a 25-year time horizon. So that was a revelation for me. It was like, if you have a business or you have some sort of key success factor in whatever it is that you do, like let's say you're a contractor and you can renovate properties cheaper than everyone else can, or you have great connections to find properties under market, you're a realtor or whatever. During this time, during these recessionary times, you can negotiate a lot harder and you can get better deals now than you could before. It's a buyer's market right now. We haven't turned to a full buyer's market, but it's definitely a buyer's market. There are not multiple offers on properties like there was 20 offers on properties in February. Now you're having offer dates being missed. That's an opportunity for you to get in there and offer on offer date. When they miss the next day, you should call them up. They're expecting offers and they got nothing. That's when you can come in at 90 cents on the dollar. That's when you can come in and start. Well, I think it'll get better soon. I think sellers still have to wrap their heads around the fact that the market isn't what it was before, and that'll take months and months. And the rate holds will expire that people have with the old cheap debt, and they'll start experiencing higher debt, which again will drive demand even lower, and price points will fall even more for what people can afford. So that's also great for people building a real estate business. I'm cash rich. Like, I'm sitting on bags of equity and whatnot, and I'm like, I could redeploy right now and probably make $5 or $10 million if I could time the most distressed pivot point in real estate in the next year. And I think that's coming this fall and this winter. I think there'll be a lot of opportunities where I can sort of stick the fork into people who are, this sounds wrong, but like take advantage of the fact that there's no buyer pool and negotiate. That is the business. You know what I mean? Like, properties sell for what they'll sell for. And so it's our job to negotiate the best deal we possibly can. If you could buy shares of Apple right now for 90 cents on the dollar, you would, right? But you can't because it's a perfectly efficient market. But real estate isn't perfectly efficient, and so neither is the business world. If you run a business or you own a business right now, you could also deploy your capital there into marketing or into other avenues that help you grow and make triple-digit returns. That's usually when I'm talking to someone on a coaching call or whatever, that's the first place I'll start, is like, what do you do for a living? What's your business? If we invested, $10,000 in your business, how does that translate? If you don't know that, you should start measuring those indicators and those benchmarks. But yeah. Okay, let me do this question real quick, just popped up. Hey, Daryl, private lending is great. Agreed. I think it's a great asset class. I think the problem with stocks right now, although they're getting cheaper, and I think that you should, if you're buying a little bit at a time, now is the time to be dollar cost averaging in, especially on the NASDAQ. It is down 29%, 30%. Could it drop to 50%? Yeah, it could happen. But I don't think you'll regret buying at a 30% discount when we reach back to new all-time highs in the next decade. So if you're a long-term hodler, you're a long-term holder, you're gonna hold the line, and you're not gonna dump your equities for, on the fleet of a moment. If you could hold long-term, you don't need that cash right now. Equities are a great opportunity. However, if rates continue to rise, and I think they might, as we try to battle inflation, there might be opportunities where your equity could drop 10 or 20%, whereas I think there are opportunities in the business world right now and in real estate right now where you can get better deals. Now, if you're in a different, like I've been in mindsets and times throughout my life where I want to focus on I have 3 kids, and like you guys know, that's my, that's one of the things I'm most passionate about is my family. And it's number one for me, because if you can spend the time raising good kids, it's like the best thing you can do with your life. It's the most impact I think I can have is by raising amazing kids. And I don't want my kids to grow up in the same environment that I had growing up. And so I do consciously make an effort to be a good dad. But I can understand how people in positions where they've got full-time jobs and kids and everything else, they don't want to go on a real estate flip or start a business in real estate. They already got a day job. They're not there yet. And if you're not there yet, you're one of the bazillion people watching, or a couple thousand people that'll watch the replay right now. I would say, lending's a great option too. I like lending because it's so passive. Like, you can just park money right now at like 10%, and like that's pretty conservative. 10%, safe, safe, safe. 10% compounding, though, is the key factor, right? Compounding every 7 years, it doubles. So if you invest now by, 2029, your money's already doubled. And if, we go through tumultuous times and maybe the market hasn't doubled in that time. So you may outperform with lending with, again, no input or energy. And so it's a very passive way. If you had like $5 million right now in equity and properties, you could refinance out. Well, that's still relatively cheap. Pull that equity out and put it out to work at 10% in a lending, type of scenario, lending business, let's call it. And if you can build a business around it, you can argue that it's a business inside of a corp. Again, it'll qualify for the small business tax rate, 12.9%. So that's key, is that, within a corp, and you build a business around it, and you hire, a part-time admin or something for $20 an hour, 20 hours a week or something. You like did the appraisals yourself, went out and did site visits and stuff. You could, sort of make it passive, but spend like 2-3 hours a week and call it a business. And then it's an active business and you're working towards building a lending capital business or something. And then you get special tax treatment too. So there is some tax piece you could put towards the lending stuff, where it doesn't have to be as involved or as risky. Like in real estate, if you drop the ball and you do nothing, you can lose money. Like if your contractor really runs up a bill and messes up your property, or a tenant destroys your building, you could lose money. Whereas in lending, it's a lot harder to lose money. If shit goes wrong, like you're the secured 70%. They got to lose their entire 20-30% down. In most cases, it's 30% down, plus whatever they bought the property for under market. Because ideally, you're lending to people who are buying properties under market value. So when you're lending 70% loan to value, you're really like 50 or 60% loan to value, because again, there's a cushion there. Hopefully they're improving the property, and that was part of their game plan. So there's a bit more cushion there. As opposed to being in the equity position, you're now in the safe, secured lender position, where the bank normally is making like 2-3%, 4% to be in that position. You get to be in that position as a private lender making 10. So you're making almost 300% what the bank does, doing exactly what the bank does. So that's something. And going through the bank isn't always the easiest. And I've had people jump on and be like, that's unethical, blah, blah, blah. No, it's not. I have a deal right now. I'm going to be putting into my dad's name and one into my mom's name and hook them both up with properties. And the amount of work it will take me to go through the lenders, to get the financing, to do all that, I'll spend 100 hours, before it's all said and done, to go through 2 lenders to get an approval with an A lender. I'd say 4% or 3.5%. It's cheaper for me to go through a private lender and pay 8% or 7%, let's call it, and just be done with it. One call, they know who I am, they verify my net worth, whatever, check my credit score, and boom, I'm funded for the year. I don't have to worry about it, especially if it's a short-term project, like a 1-year project. To get 4% interest versus, or like 3.5% with the bank versus 7% on, let's call it $500,000, it's not a ton of money. We're talking about like 20 grand, under 20 grand. That's not a huge deal when I'm making 6 figures profit on a deal. So even I will use it. Again, I'm prime borrowers. My network's very large. People will lend me at 7-8% all the time. If you're watching this, by the way, and you want to put some, like people message me all the time, I almost always say, I don't have anywhere to put your capital right now. I have 2 deals that are free and clear. One that I'm moving into my dad's name to set him up the house hack as a triplex here in London. I need like $500K for it. So if you want to park money right now, 500 grand, 550 grand on an $800,000 property in London, I'll guarantee it. I'll go on the property if need be, and I'll pay for the legal costs, everything, set it up, and pay a 7% flat done for 1 year. So if you're looking to park your money for 1 year right now, make 7%, and wait for the market to kind of tank a little bit, wait for the real estate market to cool off a bit, and then enter again. This could be a place you could park some money, better than holding on to cash, as an example. But yeah, I mean, those types of deals that come along, right? And that, I think it just makes a lot of sense. And people like are going to be screaming at me like, Mike, what are you borrowing at 7% when you go to the bank at 3%? Again, I said it's value of my time. I'd much rather make 1 phone call and be done with it than spend. If I value my time at $1,000 an hour and it takes me 30 hours and back and forth through the lender and sending documents and having them audit my bank statements, and then I have to send leases for every property, and I have to send utility bills and whatever else the bank might ask for in their anal probing. Eventually I'll get approved, sure, you're right. Like I'm a high net worth individual, so it's, with private banking, because I have such a large stock portfolio, they almost always approve me. It's just a matter of like how much of an, ravaging they want to go through and all the paperwork and all the time wasted. But anyway, yeah, so for anyone watching this right now, I've got one property that I could take 69% loan to value. So I need a mortgage for 69% loan to value. I'll put 31% down and put that mortgage so my dad can be all set up in his property. And then my mom, I'm going to transfer my properties into her name. She's already living in the property. I'm like, she could just live in the property and have it tax free because she lives there as her primary residence. Why the hell am I holding it in trust for her? So anyway, I was like, my parents both live in my properties right now. Even my grandfather lives in one of my properties right now. I support the whole family. Blessed to be able to do that. I'm not complaining. I'm thankful for the opportunity that I can actually do what I'm doing for my family. But yeah, I'm like, I should have, just thinking like from a tax perspective and just in general, it should be in my mom's name because you get in Canada a primary residence exemption. She's been occupying this property anyway. No one else, like she's living there occupying it and no one else is getting the benefit. Like I'm not getting the benefit from it. She's definitely not getting the benefit from it because it's not in her name. So that's a simple one where I could move it into her name. And, she would then get any appreciation, any whatever tax-free, and it would just be a transfer over. I literally bought the property for her. She was living it the whole time. I've been holding it in trust for her in my corp because I didn't think she'd qualify for a mortgage. But if I guarantee it and I co-sign and I put the equity up and I gift her the 31% equity, then in theory, she could get a mortgage 69% loan to value. And now any appreciation on that property, any value add, if we renovate it or anything happens to it before we sell it, or she decides to sell it, I guess, or we as a team, then that's all tax-free. That's a huge, amazing vehicle that she should be utilizing. And so having, financial planning conversations with my mom, like, how do I get her back on track? My dad, how do I get him to help him build his credit? He just came out of a bad divorce. How do I help him build his credit? How do I get him back on track? That's, I'm doing the things that I'm doing with you guys, with my own family, right? I'm trying to practice what I preach and help them, get on the same path, right? And they're both triplexes, so they can house hack. They have the opportunity to rent these units out, and then they could, in theory, they could live for free. So that's what I'm trying to get to. Trying to get to that point. Okay, so questions. Let's do the question and answer. Evening, William. How you doing? Eric says, yo, Mike, my dad wants to do private lending on his HELOC or refinance on the house. He has $500,000 mortgage and his house is currently with 1.8, denied due to no income on his job, only stocks. So it sounds like, Eric, your dad might need to speak with some net worth type lenders. There are lenders out there, like credit unions are known for doing this, especially if you give them a book of stocks. If he has a stock portfolio, even if you brought the stock portfolio, like this is between us, but like if you brought the stock portfolio over to the credit union for like 2-3 months or made it like kind of a condition. You can't legally make it a condition of issuing a mortgage, but if you brought the business over and said, hey, wink, wink, not judge, if you refinance my house 80% loan to value, I'll give you my stock portfolio to manage. And they, by the way, have private banking divisions where they will literally let you pick your own basket of stocks and they'll charge you like less than 1% to manage it. So you can literally hold all the same stocks you want, they'll hold them for you. And then after you get your mortgage back in place and refinance your house, you can pull some of that stock money back and just manage it yourself if you want to. That's how you get it done with the banks. That's how you get around the stress testing rules. That's how I've been able to get around a lot of the stress testing rules is like way carrot of like banks want to sell you life insurance and they want to manage your stock portfolio. And if they get into private banking, you give them a few $1 million to manage, they're like, oh, high net worth. Oh, we have a program to get around those stress testing rules. Like, oh, you don't qualify, you have no income at all, you're just collecting some dividends? Okay, no problem, we'll make it work. So you'd be surprised what lenders will do without income if you have high net worth. Now, if you don't have high net worth, then you need some income. Unless you go to a B or a C tier lender, which again, you're gonna pay like 8%. It could be worth it. I don't know. I don't think it really is worth it to borrow that kind of money against your primary residence. You're not gonna make that much of a spread. But on a rental property, it can make a lot of sense. You could buy another rental property with that capital. Depends what you're doing with the money. To buy stocks right now, I don't know, borrowing 8% is pretty expensive to buy stocks. I don't know if I would do that right now, the market being what it is. Okay, next question here. Jeff says, redeploy in Winnipeg. I don't know a whole ton about Winnipeg. Sounds like Winnipeg's a little bit beat up with the whole Epic Alliance. There's a surplus of inventory, so maybe there might be opportunities there. The reason I invested only in London and my surrounding area was because I could touch it, I could feel it, I had expertise in this market. For me to go and develop an expertise there, I'm more likely to go, and I've been developing an expertise. I look at the MLS and Crexy and all the multifamily stuff, and I'm just living and glued to the Florida realtor.com right now. And there's a couple of strategic lifestyle reasons. I will probably buy a few boutique, beachfront, resorts and some cottage stuff. I want to build a business that's lifestyle driven. So there's definitely a desire, I think, to build something in Florida, in the Bahamas for tax purposes, of course, too. And then I think in Canada, there's a real play right now. It's interesting if you look at the data right now. Waterfront property is still appreciating, has not dropped at all, despite the fact that real estate is dropping in Ontario. Waterfront in Ontario is not dropping right now. It holds its value better. So if I can find a strong cash flowing play between like Sarnia and Granbound, that's the area where I grew up. So I know it like the back of my hand. I love it. There's more sentimental reasons probably why I'd want to buy some sort of resort there. But if I could, there was a property. Two properties that I've seen ever that were perfect, and I let them slip away out of my hands both times, and I regret the second one so badly. It was like 19 cottages on the water, beautiful, beautiful property. If I could find something like that again, I would jump on that. But I don't know, like I'm not just chasing return, right? Like I'm sure I could go to Winnipeg and find like 12 cap properties or something, and like Winnipeg's pretty, especially in some of the rougher areas of Winnipeg. The 2 times that I have been to Winnipeg, one of the times I just drove through on my way to Vancouver, it's rough, you know. It's cold in the winter there, very, very cold. It's not that desirable of a place. I don't think it will appreciate in the same way. So I think long term the fundamentals aren't as strong. The tenant profile is not as good, but yeah, I mean there's some good cash flow there for sure. If I was living there, then I think there'd be I could develop a competitive advantage there. I currently have no competitive advantage in that market, right? And so I can't, like in London, I can buy better than the average person. But in Florida, I'm starting to develop those connections to wholesalers and starting to talk to a lot of realtors and starting to build those connections. We have a property closing there for 130th worth 275, and like so there are lots of opportunities where I can buy 50 cents on the dollar in Florida, and it's getting better. I think 40 cents on the dollar for some of these foreclosure houses and some of these distressed properties is likely impossible. So I might start wow, I got a super chat and it got retracted. There's a message, but it got retracted. Derek, thank you for the super chat. Appreciate that. It tells the algorithm that there's value here. It tells YouTube, hey, there's something going on that people are willing to pay for, and they get a cut of this money, right? Like 40% or something. So, yeah, there's just some distinct advantages, I think, too. Like Florida's beautiful because it's warm all year round too. Like there's no winter heating costs, and there's the landlording environment there. I can literally just jack the rent up 50%, and the tenant can't do anything. Like if I get a tenant that's ignorant to me, it's like, fuck you, Mike, blah, blah, blah. In Ontario, I'm like, oh, thank you. There's nothing I can do. So like, let me give you the best customer service possible because I can't evict you. And if I don't do everything properly, you can just take me to court. But in Florida, it's like your rent's 100%. Like it's $2,000 a month now. In 2 months, it's $5,000 a month now. Paid or leave. Eviction, done. That's what I like about that climate in Florida. It's just way better. And I don't see that changing with the current leadership. I think Florida's going to be a great place to invest for the time ahead. And there's a correction, I think, coming to Florida, and I'm excited to get in when that correction really seeps in. Some of the higher interest rates have already started to stall a lot of the boom. From when I was there in January, February, things were insane. And it's coming down a bit. Things are calming down. That's good. It's making a more balanced buyer's market. It's where I want to be as I'm entering the market. But really for me, it's about lifestyle, right? Like my end game is still Bahamas, tax-free. Personally, I found no tax return. I'll have a corporation that will invest in probably the US and Florida and maybe a couple other states that I find favorable. I'll have a Canadian corporation still that will have some Canadian holdings. Probably my end game would be like a nice resort on the water. They'd be cash flow pumping. I feel really good about waterfront on Lake Ontario, or Lake Huron, sorry, in Ontario. So they're like, I'd like to hold some real estate in Costa Rica too. So I'd like to be invested in 4 countries, 5 countries, spread out with a resort style investment opportunity in each of those areas. And I like resort style because I think that long term, we're going to see this divide between the rich and poor continue and grow, at least in my lifetime. There will be a correction at some point, but I don't think it's going to be in my lifetime. And the rich are going to be richer than they've ever been. And so I think the vacation plays, the resort catering to that vacation piece will be, I think a really great business to be investing in. There's only so many of those types of properties, and they're very rare. And I like it's like collecting Pokemon cards when I was a kid, or like all that stuff. Like it's just they're rare gems that I would like to hold and collect. And if they can produce a ton of cash flow that can fund, an exuberant lifestyle that'd be cool too. You know, I'd be cool to be jetting around from like Bahamas to Florida to Canada to Costa Rica to back, and I wouldn't mind that. That would be kind of fun. So trying to build businesses around the life that I want to live. I actually had the 1996 Charizard in almost mint condition. I had the whole thing. I had Venusaur, first edition, yeah. I had Bulbasaur. What was the Venusaur? Was the evolved form. I had three. I had the fire, the water. What's the water one called? Blastoise. Blastoise. But yeah, I still have a whole bunch of those Pokemon cards. I gave a bunch away when I was like 21. Someone, I think a friend of a friend bought most of my cards off for like $100. And I had so much. I had like all the holos from like Mew, Mewtwo holos, all of them. Like I had every one of the good holos. The first like 10 pages of my sheets were all filled with holos on both sides. And yeah, I sold most of them. I still have a huge collection. I also have a huge collection of like random. I went yard sailing when I was like 12, and I got this really sick. Opportunity where I was able to buy like a huge stack of baseball cards, hockey cards, and basketball cards. So I have like Pat Quinn rookie card. I have like Dennis Dry, like 1960s, 1970s, all these great hockey players. I have all of their cards, and they're probably worth a pretty penny now. I don't know. They're like 60 years old, so I have them all in plastic and protected and stuff. So that was a cool yard sale find way back in the day, like $5-10, I think, and they're probably worth like $5,000 today. Yeah, there you go. A little Gary Vee for you. I was doing the yard sale stuff before Gary Vee was on social media, I think. But yeah, we like minds, like minds. Adventures on Vancouver Island says, are you still trading options on margin right now? No, I'm not. I'm staying off margin for the most part. That's not true. There are a couple days where I'll dip in. Like if I see a really big dip day, I'll dip in on margin, and then I'll be like prepared to close those trades the next few days. So there are times where I'll dip in on margin, but very rarely. Yeah, very rarely. Let's do some rapid fire. Get me caught up here. Selling puts on BAC, HD, GM, Ford, Manulife, making tons of money. Good for you. Nice. I think there's, as long as we have this bear market fear, there's a huge rotation right now between all of the growth, the tech into value, right? People feel like they're safe in insurance companies, whatever. So that's been doing really well through this time. So you can't go wrong there. So especially selling puts while things are rising. Any internet sites or companies you'd recommend to start exploring safe private lending in America? It's a great question. There's a bunch of websites like lending. I think it's like Lending Tree. And if you just type in like lending, real estate lending, you'll find a ton. You can call some brokers up too, talk to brokers. They'll introduce you to people who are looking to borrow. Just be careful. Like I like social media the best because I can watch what's going on with people I'm lending to. So it's almost like a requirement that they have social media. Yeah. Next question. Which real estate market do you like to deploy the cash? So it depends. I think the one in which you're living in is a good candidate in many cases, unless you live somewhere like Toronto, Vancouver. I don't know if there's as many opportunities there, but even in Toronto or Vancouver, there are opportunities you can find for, if you're really good at finding opportunity, there is opportunity still in those markets. But for the average person buying on MLS, yeah, there's nothing. Not worth it. Hey, Mike, I met your Instagram last week after your live stream about crypto miners. I haven't heard back from you. I'm sorry, I'm bad for responding to messages lately. I've been getting so many on Instagram and Facebook that I read them all. But sometimes I forget to respond, and an hour every day and try to respond to them all. So I'm sorry if I didn't respond to you. My bad. But let's see. Okay. Yeah, if you're interested to talk Kyler more, I have 16 rigs right now that are in a place where the sound of them is pissing off the neighbor a little bit. So I need to move them. So if anyone wants a JV on those 50-50, and you have if you have a 200 amp panel, you probably have the capacity to add 3 30 amp plugs, and you could power these bad boys up. They're a little bit loud. You need good ventilation. You need a window, like a nice large window coming in and one going out. So ventilation is important in and out. That's it. AC, nothing else, just ventilation and power. So if you have that and you want to partner up in your London area, hit me up. Yeah. Brock says, old guys like Kiyosaki and the others think interest rates could get high like 10%. To me, the majority of the market would implode and a deep depression would follow. How high do you think rates could get? So, I think Kiyosaki is peddling a little bit of fear because, again, he's very like gold and like safe stuff type investments in his courses. All that is a bias. So I would say, is it possible? Yes, it's possible. Some rates could hit 10%. Do I think we'll sustain at those points for very long? No. Short term, it's possible we could see that. It's, I don't know. To fix inflation back down to 3%, I think they need to hike about a 1.5% more. That's my best guess. Maybe less. So in Canada right now, you can still get mortgages at 3.5% pretty easily, like some decent 2.99 promotions and stuff. So, I mean, could we get to 4.5% here? Yeah, I think so. It's possible. But do I see 10%? That's a significant jump. In that type of environment, some of the growth in tech would get temporarily, valuations would get skewed quite a bit. So there is risk with that. Rising interest rates like that would also depress the stock market. It would depress all sectors of real estate. It would lead to a real depression that would be felt in all sectors, including insurance, including banks, and everything. So the government themselves are in such debt right now that the amount of tax they'd have to levy to cover the interest payments on their own debts that they owe each other at those interest rates would be reset type, like global reset type of level events at 10+% with the levels of debt that exist on the balance sheet today. So is it possible? Anything's possible, right? Like, that's why we try not to short, because we don't know what can happen, right? It's endless losses, right? As things go to zero, we don't know. But I don't know. I wouldn't bet on 10% interest rates at this time. Would not bet on that. Next question was Yuri says, arguably Mike's snowball method won't work in such a highly priced London environment. Almost non 1% will exist. Would be great to redefine the process using new prices and rents and what it would take to execute on. It's a good point. Would it still work? Yeah. You can still do exactly what I did using the snowball method. Would you be cash flow neutral on a lot of these properties? Close. Refinanced right now in London, properties are cash flowing $50 a door ish, 50 to $100 a door. Now, if you apply Airbnb or you build a business around it, you could get it to maybe like $200 a door, $500 a door on the conservative side. This is with running numbers for CapEx maintenance. So you'd actually have a little bit more cash flow than that until a maintenance or a CapEx event up. But yeah, I mean, it still works. Like a BRRRR works in any market. You can literally take the property and do another one, pull the equity out, do another one. The whole concept behind the BRRRR is just buying stuff at a discount, whether you're renovating it or changing the tenant profile over, but increasing the NOI, usually through renovation and changing the tenants over. And then you go refinance. So it's as simple as like the comps look like this. You buy it for this, you unlock that value. You could do the Rosehart snowball and, at the end of the 10, be like, oh, I'm not cash flowing all that much, but I've made $2 million in equity. Like if you the 10 properties still make you 6 figures in every one you do. So if you do the Rosehart BRRRR, you make $1 million in a year, right? Like it's aggressive to find those deals and to line all that up. It might take you 2-3 years to do that, but I believe anyone could do it over 3 years. It's a lot of work. Like you're gonna have to grind your ass hard to find those deals. You gotta look at 100 to find the one that's right. You gotta renovate that property while you're still looking for more deals, while you're still working full time to qualify for the mortgages to keep doing it. Is it harder to qualify these days? Yeah, it is. Undeniably harder. Yeah, I mean, it's not as easy to do it today as it was then, but it's still doable. And there's still markets you could do it in too. Like you don't have to pick London. You could pick another market doing it. And could you still make $1 million and invest in stocks after? Sure. Or do private lending, whatever. Like, I don't know. There's less appeal, I think, today to hold. Like when you finish the BRRRR, there's an appeal to want to just sell the property because cap rates, like you can buy at 10 cap rate, but then the market cap rate's like 6, 5. So then it's like, do I want to hold a 5 cap property? I don't know. Like it's not that desirable. So every time I get to the end of the project, like I buy it and I'm like, oh great, it's 10 cap. But I fix it up and I'm like, oh, it's now worth a 5 cap. Might as well just sell it off. Like the cash flow isn't strong enough to want to do the holding piece. Other than the tax tail wagging the dog and you deciding that, hey, I don't want to pay capital gains tax. That might be a reason why you'd hold. But I think you do the BRRRR strategy, you just sell after each one. You build up a huge capital base and then you retire off that capital base. You lend it out, whatever. So you still do it. The BRRRR method, the 10 BRRRRs that I talk about is just flipping, but you don't sell at the end. You hold. Yeah. Hey, Quentin. How you doing? Foster. Brandon, how you doing? What areas in Florida have these foreclosures? What are the entry levels for us basic investors? Thank you so much, Mike. All over Florida, pretty much every market you can find these deals on. Start calling a bunch of agents down there. Talk to a bunch of wholesalers down there. They are popping up, and there's way more in the pipeline coming soon as people refinance with these new rates. In Florida, by the way, as a foreigner, you're looking at like 6.5% mortgage rates to borrow and buy something. So that's expensive, and that means that people will walk away. Also, here in Canada, there's recourse versus non-recourse mortgage, and there's recourse mortgages here, which means they'll take the shirt off your back if you try to walk. In the US, mortgages are non-recourse, meaning you can walk away from your house and they just take the house. They don't come after your car, your assets, nothing. You just walk away, give them the keys, the bank takes the house. It's just a different type of world in Florida, and so things are more drastically felt there, which is good. Da, 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 da. Hey, Eric, thank you. Says, thank you, Mike. God bless. God bless you as well. Sam says, hi, Mike. I work in the government department with approximately $80,000 in income. I do not own a property because I'm not sure about relocating or where I will be remote. Sam says, is it okay that I can't buy property in a location if you can't work there? Yeah, I mean, you could still buy property that's not in the same city that you live right now. There's nothing wrong with that. You can own rental property. You can definitely develop a power team, have a good realtor, have a good property manager, have contractors, et cetera, so forth, look over each other's work and whatnot. And yeah, I mean, you could totally outsource. There's no reason you couldn't do that. I think with real estate, you can make even super passively, you can make like 15, 20% return, forgetting about appreciation, like just on cash flow alone. So if the market goes sideways, you don't care because you're making cash flow every month. And that's the point. If you buy property, you don't care about what the price does. Like Warren Buffett says, like if you have a farm, you don't go there and like check the yield and like make sure if it's down or up 5, 6%. You're not checking the price of the farm too every friggin' day because you're gonna hold the farm in 50 years. What do you care what it does next year? You care what it does 50 years from now because your exit point is 50 years from now. But the price goes up or down, you're not doing anything. You're holding the property. So you don't give a shit about what the price of the property is unless you're planning to exit. So are you planning to exit on that deal? And if you're not, then don't worry about it. Don't look at the price. Look at the cash flow. Do you leave it to property management? Yeah, I mean, you can do that totally. Net 450K, not interested in owning where a job really is. I mean, that's fair. People invest out of province, out of state all the time. Sell versus refinance question. After you purchased and stabilized a property, how do you determine if you should sell or refinance the property, i.e. cap rates below borrowing costs, etc.? Yeah, I mean, it's up to the individual person. I think everyone has a different risk tolerance and a different idea for what it looks good to them. I think, as a general rule of thumb, if your borrowing cost is equal to or less than the cap rate of the property, that's in a guaranteed sell because every dollar you're borrowing is costing you more than it's earning you. If your property net of expenses has a net cap rate, cap rates don't include financing cost, right? Your cap rate comes in at 4%, like in a lot of major cities. You're borrowing at 5%. You lose 25% every dollar you borrow, basically, right? Or 20% every dollar you borrow. That's huge. That means that the only way that property makes sense is if you own it in cash. And any property you can't lever up at today's interest rates is a garbage property you don't want to hold. That's my opinion. It comes down to like to the property too, right? If it's like an amazing property that just is like you love it and it's all brand new, no deferred maintenance, it's just great tenant profile in an amazing location, and your goal isn't to make cash flow from it. You're like, I'm gonna hold this thing for 25 years, and I just want to sell it for a bunch of money later on. I have had investors explain that. I still haven't gotten that yet. Maybe I'm just not rich enough yet. I don't know. But like I've had investors explain that feeling to me where they're like, or they're not losing, but they're breaking even. They're like, I don't care if I have 50% loan to value. I have half of the money tied up in it. Over the long term, I'll make lots of money. It'll appreciate. I'll make my 5% a year. And some investors are like, they just feel good about the asset. They make their 5% a year and they're happy with that, right? Like they make their 5% appreciation and they're cash flow neutral and they're paying down their mortgage over time. And so over the long term, they make their 5% plus their mortgage pay down. Maybe that's another 2-3%. So they're making their 7-8% and they're happy with that. And that's okay. There's nothing wrong with that. I just feel like owning property is a lot of work versus lending. I'd rather just lend out at like 10% or 8% and do nothing. Like owning a property, you got to pay all the bills. You got to deal with the property manager. The city might come in and do a fire inspection every 2 years. You got to deal with bullshit. Even on the nicest buildings, there's still work. Potentially going to court with the tenants. There's still a lot of risk and a lot of work. And I feel like for the amount of money, I just don't feel it at like less than a 6 cap. I'm just no interest. Next question. There it is. I can pay that because I'm still cash flow positive or break even if I do 5-year loan. So I don't know what that's related to. I must have missed a question. But yeah, talking about private lenders, I guess that must be what it's related to. One of the best things about Alberta is non-recourse mortgages. Interesting. I didn't know that Alberta was non-recourse mortgages. Although it's never really been an issue for me because I've never walked on a property. I never planned to walk on a property. I have a huge net worth that I would guarantee every deal. But yeah, I mean, that's kind of scary though, right? Like recourse is great because it creates a stickiness in the price. So you can't drop so much. It's scary because with non-recourse mortgages, people can walk away and then your housing market's fucked in a recession. So it's actually a bad thing, but it can be a good thing if you're looking to enter a market when it's depressed. Alberta would not be the place I'd be wanting to go right now because oil is doing so well and commodities are so pumped up right now that I think it's going to be a lot of buyer competition. As opposed to Ontario right now, there's not a big buyer pool. There's not a lot of competition. So there's opportunity, I think, to negotiate better deals than you can in Alberta right now. Alberta was amazing. Like if you had the foresight to be in Alberta in the fall, which I know a couple people who were, that was the best because oil hadn't spiked yet. People were getting it at the right time. I think that ship has kind of sailed unless you have a competitive advantage in Alberta already. Yeah. No. Okay, found my spot. I don't know anything about Edmonton property, but people say it's a good time to buy. Could be. If you're living there and you're house hacking, hell yeah. House hack is always a good idea if you can get your living costs down to zero or near zero. Everyone should be house hacking until they're rich enough that they can afford to retire. And then they can choose to not house hack if they'd like. My personal opinion. Loan out 8 to 10%. How does that work in terms of taxes since you are in the Bahamas as a permanent resident? Good question. I haven't fleshed that out all the way, but I would think that lending into passive real estate would incur withholding tax. So in theory, that could suck. So lending might not be so great unless I had a Bahamas Corp that was investing in like an active flipping business of someone in Canada. Then there's ways I can invest in their active business and I can do it tax-free. There are some loopholes I was reading about online. So yeah. Mark was one of the people who I know of that was acquiring properties there as well. It was very good timing. Is getting a bachelor's degree in finance worth it if it's unrelated to your career, only for personal interest in education? I don't think any formal education is worth it, and other than for like your personal benefit. Financially speaking, a master's degree, an MBA, a regular university degree, for the most part, is not worth it. You can learn anything that you want to learn online, and there's, I think, better private courses out there for cheaper that you can get more targeted. Whereas in a degree, they're going to force you to take courses that are not relevant, that you don't want to take, and the paper is worth nothing. Who cares if you have an Ivy degree or I have an Ivy degree, who cares? I mean, anything. I wasted 100 grand on that. I could have learned, in that 4 years, I could have learned so much more having my own, if I just bought a bunch of great courses. And again, you can buy the books and you can literally read the content. Like there's, all the textbooks are out there for every business course everywhere. So yeah. Steven says, hit the thumbs up button, show some appreciation. That would be cool. That'd be cool. If you're watching this right now, hit the like button. That'd be cool. A monster pig's coming here to troll. I don't know if I guess we could use crash in different terms. I think that a 25% or 30% pullback is considered a crash. That takes us back to last year's prices. I mean, do I think we'll go back 3 years ago in price, like 100%, or 50% crash? I don't know. Prices are pretty sticky. I think government would step in, to be honest, before we'd see that. How do you find and build a power team? So one way is just to get on the phone and start dialing. From one person referred to another person, referred to another person. Property manager talks to contractor, talks to, whatever other connections that you need. I went to the Richard Ivey School of Business. It's the best business school in Canada. People at U of T try to argue, and Queens try to argue that their program's, good. It's up there. They're a close second. The Harvard MBA program, Kevin O'Leary got his MBA from there as well. They are modeled after the Harvard Business program. They use a case-based methodology to teach. It's a great program, don't get me wrong. It's overpriced, but it's good. You will learn way more, way better, and just the quality. Yeah. I don't know about Schulich. I disagree. At the time, Ivy was the best. I don't know what it is today, but at the time, Ivy was the best. I did all the research. There was no school that I couldn't get into at the time. So I'm sure that it was Ivy. Is it still? I don't know. But the program was really good. There's great people in the program, great professors, great, just in general, great cases, great program. Nothing bad to say about it, other than it's expensive. And you're spending 4 years of your life chasing a degree. I wish instead I went into a plumbing business or something, right? I made 60 grand a year for that time and invested that in real estate. So when I graduated by year 5, when I was, after my graduating year, I'd already have 6, 7, 8 properties. I have a couple $1 million. And the time value of that, by time 65, is $100 million. So the cost of Ivy is really $50 or $100 million for those 4 years where I could have been aggressively growing faster. So for me, someone like me, already I was going to succeed no matter whether I went to Ivy or not. I was going to be a multimillionaire. That was going to happen. I should have just went into the trades or something. I would have been better off today. Anyway, it is what it is. I have an Ivy degree. Woohoo. I graduated top quarter of my class. Woohoo. I graduated top 1% of my local high school, my city. Woohoo. Who gives a shit? It doesn't matter. I thought at the time I studied so hard thinking my 97% average and my full ride scholarship, that shit mattered. No one gives a fuck. The business world doesn't give a shit about the fact that I was a top achiever there, right? Or that I busted my ass 80 hours a week working full time and going to Ivy. My bank account is thankful that I worked full time while I went to school because I graduated debt free. But still I wasted that 100 grand. I could have invested that into properties. I already had my first property at 19 while I was going to school. Imagine if I could have got 4 or 5 or 6 instead of struggling to get through the tuition debt free. I could have invested that and it would have catapulted my trajectory today, potentially. I don't know. I just learned a lot of valuable skills that maybe I applied in business in certain ways that had helped me grow faster. I don't know. It's hard to pretend that I didn't have that Ivy degree and all that education, all those learnings, and how that would have changed me, I guess. I was already a high achiever, so maybe I wouldn't hit the same heights. Who knows? Who knows? I think I would have sought out the information that I was looking for. I would have taken those courses just privately for $1,000. I went to a mastermind and learned the same shit that I needed to know to run a business. I think, but who knows? What would I have done without those sustainability and business classes? Learning how to not fish away the whole fucking ocean. How useful that was. What a waste of a class, to be honest. Okay, I gotta wrap this up. I didn't realize what time it was. I gotta put my kids to bed here in a second, so sorry for rocking the table there. My bad. Do you guys notice the better quality, by the way? I bought a brand new iPhone. It's my first ever brand new phone. I've always had shit used phones, and I was like, you know what? I'm gonna splurge for once. I'm gonna get a nice new phone. And you know what? The quality of my video looks the same. Even this brand new iPhone 13 Max camera shit, it looks the same to me. I don't know. My iPhone 8 I was doing my streams, like if you click back like 7 streams ago or 6 streams ago, whenever I got the phone, I don't know, like maybe 5 streams ago, I don't even notice a difference in the video quality, like nothing at all. So I don't know. They talk about phones being like the screen is bigger. It's nice. I have a nice big screen now. Cool. The battery also is amazing. Can't complain about that. It was a good investment. Overall, great investment. And I bought the phone off someone who had just opened it. It's never been plugged in or used, but I got it used, saved $300. Still frugal. Instead of $1,400, I got it for $900. So I saved $500 on it. And I threw in a case, which was sweet. There's a store, I just opened it. No one had used it yet. Still brand new, still under Apple Care, but it's technically brand new, but not brand new from Apple. So anyway, hit the like button. That'd be cool. Yeah, we've got 30 likes right now. Let's get it up to 31. Let's keep going. Facebook Marketplace for the win. Anyway, guys, I got to wrap this stream up. I've been going a little long in the tooth today, so we're going to wrap it up. Remember, the secret to unlocking a wealthier you is 3 levers in your control of your financial future. Spend less, earn more, and maximize returns in the difference. 34 likes. Let's go. Keep hitting the like button. I'd appreciate it. Thanks, everyone. We'll see you guys all next Wednesday. And of course, on Facebook, Mike Rosehart, you can find me, a little blue check mark beside my name. On Instagram, no blue check mark, sad face. But it's at Mike Rosehart. I post my stories there 6 to 8 times a day. So yeah, we'll see you on. Bye, everyone. Oh, and if you want to lend on that private deal, hit me up on Instagram. That's the way to get a hold of me. Or partner up on a deal ever. Again, same place to get a hold of me. Bye, everyone.